Okay, so you've definitely seen EPS popping up constantly, right? In earnings reports, analyst notes, maybe just on your investment app. You
Yeah.
get that it's important, but what if you could really, truly understand it? Not just recognize the letters, but grasp its power, its pitfalls, and how the pros actually use it. Well, today we're doing a deep dive into exactly that, earnings per share or EPS. We want to transform it from just another metric into, well, a powerful lens for you, our mission. Unpack EPS, make it super simple to grasp, show you why it matters, how the smartest folks use it, and crucially, what traps to watch out for. We've pulled insights from, the core stuff, company financials, earnings releases, the data sites, all to give you that aha moment without getting bogged down.
Exactly. And it's worth doing because EPS really distills so much information. It takes a company's entire performance, essentially, and boils it down to a single per share number. That makes it incredibly useful for comparing companies or just figuring out valuations. It's compact, but really powerful.
Okay, let's unpack this then. So at its absolute core, what is it? For most companies you'll look at, EPS is simply, well, how much profit the company made for each common share of its stock.
That's it. A per share measure of profitability. Clean and simple.
Which is why it's so useful for comparing, say, a giant company making billions with a smaller one making millions, because it puts everything on a per-share basis.
Precisely. It levels the playing field, makes comparisons much more meaningful, whether you're comparing different companies or just evaluating one stock against its own history.
So how do they actually calculate it? The formula might look a bit, I don't know, academic at first: EPS, net income, preferred dividends, E-weighted average shares outstanding. But let's break that down.
Let's do it. So net income, that's the bottom line. The company's total profit after everything else is paid costs, taxes, interest.
Okay, the final profit number.
Right. Then preferred dividends. These are payments that go out to holders of a specific type of stock, preferred stock. They get paid before common stockholders, like us, usually.
Got it. So you subtract those first.
Yeah. And then the last piece, weighted average shares outstanding. It sounds complicated, but it's basically just the average number of common shares floating around in the market during the period. The weighted part just adjusts if the company issued new shares or bought some back partway through the year or quarter.
Okay, that makes sense. Let's try a quick example just to see the math. Say a company has net income of $100 million,
Okay, $100 million profit.
and they have preferred dividends of $5 million that need to be paid.
Mm-hmm.
And their weighted average shares outstanding are, let's say, 50 million shares.
Right. So, step one, take the net income, $100 million, and subtract those preferred dividends, the $5 million. That leaves $95 million. That $95 million is what's actually available for the common shareholders.
Okay, simple enough. And step two.
Take that $95 million and divide it by the number of shares, the 50 million.
So $95 million divided by 50 million shares is $1.90.
Exactly. EPS is $1.90. See, the math itself is just subtraction and division once you know what the pieces mean.
It really is quite straightforward when you break it down like that.
Absolutely. And what's amazing is how much that one number, that $1.90, actually tells you, and why it's so important for you as someone trying to understand the market to really get it. For instance, it's the E in the famous PE ratio, price to earnings.
Ah, yes, the PE ratio. You definitely see that everywhere.
Yeah.
So if a company has a higher EPS, assuming the price stays the same, that makes its PE ratio lower, right? Makes it look cheaper.
Precisely. All else being equal, a higher EPS makes the stock look more attractive on a PE basis. It really anchors that whole valuation metric. It's fundamental.
Okay. And beyond just valuation.
Well, think about trends. A rising EPS over time, usually a very good sign. It signals that profitability is improving. Or it could mean the company is buying back its own shares, which reduces the total number of shares, so the profit gets concentrated among fewer shares. That also pushes EPS up.
Right, making each remaining share theoretically more valuable.
Mm-hmm. And it also connects to market reactions. You hear about earnings surprises, right?
Oh yeah, stocks jumping or plummeting after earnings.
That's almost always driven by EPS. Did the company beat what analysts expected for EPS, or did they miss? That comparison is a huge, huge driver of short-term stock moves.
Because it changes the story, essentially.
Instantly. It challenges the market's assumptions about the company's health and future prospects. And, it also helps you gauge sustainability. Can the company afford its dividend? Can it keep buying back stock? Looking at the EPS gives you a clue about whether those things are supported by actual earnings.
And you mentioned analysts. They focus heavily on that.
Oh, absolutely. Wall Street analysts spend a huge amount of time building models to forecast future EPS. That's often called forward EPS. And when a company gives guidance on what they expect future EPS to be, that number heavily influences how the stock is valued and traded right now.
Okay, so we've got the basic EPS nailed down. But like you said, it's not always quite that simple. You look at a report, and suddenly there's more than one EPS number.
Huh, yes. Just when you thought you had it. You'll definitely encounter different flavors of EPS. Each one tells a slightly different part of the story.
So beyond the basic EPS we just calculated, what's next?
The next big one you'll always see is diluted EPS.
Diluted. Sounds like it means less.
It often does, yes, and it's really important. Diluted EPS shows you a kind of worst-case scenario for earnings per share. It considers the impact of things called convertible securities. Think employee stock options or maybe bonds that can be converted into stock.
Ah, so things that could become common stock shares
Well,
eventually.
yeah, exactly. If all those options were exercised or bonds converted, it would increase the total number of shares outstanding. More shares dividing the same profit means.
Lower EPS per share. It dilutes the value.
Precisely. So in our earlier example, we had $95 million in profit for common shareholders and 50 million shares, giving $1.90 basic EPS. But what if there were options and convertibles that, if exercised, would create another 2 million shares? So 52 million shares in total.
Okay. So then you divide the $95 million by 52 million shares instead.
Right. And $95 million divided by 52 million shares is roughly $1.82, $1.83 actually, $1.8269. See how it's lower than the $1.90 basic EPS?
Yeah, definitely.
This diluted figure is more conservative. Investors look at it because it gives a more realistic picture if all those potential shares did come into existence.
Got it. So diluted is the cautious number.
Right.
Okay, what about GAAP versus non-GAAP? I see those terms constantly, especially in headlines.
Right, another key distinction. GAAP EPS means earnings per share calculated according to generally accepted accounting principles. These are the strict, standardized accounting rules in the U.S. designed to make financial reports consistent and comparable. Think of it as the official rulebook number.
Okay, the by-the-book calculation.
And then there's non-GAAP EPS, sometimes called adjusted EPS. This is often the number companies highlight in their press releases.
Yeah, they seem to prefer this one sometimes. Wow.
Because it allows them to exclude certain items they consider one-off or not part of their core ongoing business. Things like big restructuring charges, costs from an acquisition, maybe a large asset write-off. They argue that excluding these noisy, unusual items gives you a clearer picture of their actual operating performance day to day.
So they're saying, look, ignore that weird thing that happened this quarter. This adjusted number shows how the real business is doing.
That's the idea. They want to show you what they see as the normalized profitability. But, and this is crucial, companies must show you how they got from the official GAAP EPS to their adjusted number. It's called a reconciliation. You absolutely need to look at that to see what they took out and decide for yourself if you agree with those adjustments.
Right. Transparency is key there. Okay, so we know the types. Now, practically speaking, if I want to find these numbers for company X, where do I actually look?
The absolute best source is always the company's own filings, the official documents. Specifically, you look at the income statement, which is inside their quarterly report, the 10Q, and their annual report, the 10K. They file these with the SEC.
Okay, the official filings. Maybe a bit dense for a quick look, though.
They can be. So for quicker hits, the company's earnings press release is great. They'll announce their headline EPS numbers there. And importantly, if they do talk about adjusted non-GAAP EPS, that press release is usually where you'll find that vital reconciliation back to GAAP.
Good tip. Any other spots?
Well, the presentation slides that often come with the earnings release can be useful too. And if you really want the context, listening to the earnings call or reading the transcript gives you management's own explanation. And of course, for easy access, financial websites, Yahoo Finance, Google Finance, Bloomberg, Seeking Alpha, your brokerage site, they all aggregate and display this data, often alongside analyst estimates.
Perfect. So plenty of places to find the numbers. Now let's talk about how the pros use this. Experienced investors, analysts. They're not just looking at one number in isolation, are they?
Oh, definitely not. It's much more dynamic. For example, they're constantly comparing. They'll look at the trailing 12-month EPS, or TTM, that's the actual EPS over the last year.
Okay, what actually happened?
Right. And they compare that to forward EPS, which is what analysts expect the EPS to be over the next year. That comparison helps them gauge growth expectations. Is the company expected to accelerate, decelerate, stay flat? It tells a story about momentum.
Makes sense. Looking back versus looking forward. What else?
A really crucial thing smart investors do is they decompose the EPS number. They don't just take it at face value.
Decompose. What do you mean?
They try to figure out why EPS went up or down. Is it because the company is genuinely growing its business, selling more stuff, becoming more profitable, increasing its margins? That's, real profit growth. Or is the EPS going up mainly because the company bought back a ton of its shares?
Ah, that distinction we talked about earlier, growth from the actual business versus growth just from shrinking the share count.
Exactly, is a massive difference. One implies the underlying business is getting stronger. The other might just be, well, financial maneuvering. It doesn't necessarily mean the business itself is healthier. Pros always look for the source of the growth.
That's a really key insight. What else are they looking at?
They'll definitely toggle between adjusted and GAAP EPS, like we discussed. Use adjusted to understand the core operations, but always check that reconciliation to GAAP to see what's being excluded. No free passes there. And they keep a very close eye on potential dilution. Are there lots of stock options waiting to be exercised? Convertible debt coming due? Could the company need to issue more shares soon? Anything that increases the share count is a potential drag on future EPS.
Right. Always thinking about that denominator in the equation.
Yeah.
Okay, so let's flip that. We know how pros use it smartly.
Yeah.
What are the common traps or pitfalls that someone just learning about this should watch out for?
Number one, again, has to be those one-time items affecting GAAP EPS. A big asset sale can make GAAP EPS look amazing for a quarter, but it tells you nothing about next quarter. Conversely, a big restructuring charge can make GAAP EPS look terrible, even if the underlying business is fine. That's why you have to look at adjusted EPS and that reconciliation.
Don't be fooled by the one-offs. Got it. What else?
The buyback boost. We just touched on it. Remember, buybacks reduce the share count, which mathematically increases EPS, even if net income is flat or even slightly down. So higher EPS driven only by buybacks isn't nearly as impressive as higher EPS driven by rising profits. Always ask, where did the growth come from?
Higher EPS doesn't automatically equal better business. That's worth repeating.
Definitely. Then there's the flip side of buybacks, dilution risk. If a company issues more shares, maybe for an acquisition or just to raise cash, or if convertible securities turn into shares, your EPS goes down. Less profit allocated to each share.
So watch the share count. Is it shrinking or growing?
Exactly. And, sometimes there can be, let's call them accounting gimmicks. It's less common with strict rules, but things like how aggressively a company recognizes revenue, unusual tax benefits, or non-cash gains can sometimes inflate EPS temporarily without reflecting true business health. Requires a bit more digging, usually.
Okay, something to be aware of. And the last pitfall.
Just basic timing and seasonality. Always compare like-for-like periods. Compare Q2 this year to Q2 last year. Compare the full year 2023 to the full year 2022. Don't compare Q4, which might be huge for a retailer, to Q1, which might be slow. That just reflects normal business cycles, not necessarily underlying improvement or decline. Context matter.
Makes total sense. Okay, this has been incredibly helpful. So to wrap up, let's empower the listener. You see an EPS number in the news or a report. What's a quick mental checklist you can run through before just accepting it?
Great idea. First ask, is that GAAP or adjusted EPS? And immediately follow with, did I see the reconciliation? Know which number you're looking at and what's been excluded, if anything.
Good start. Second,
Is the EPS basic or diluted? Remember, diluted is more conservative, includes potential new shares. For a cautious view, focus on diluted.
okay. Third point on the checklist.
Ask yourself, is this EPS growth coming from real business improvement, like higher revenue and margins, or is it mostly just share buybacks? Understand the driver.
Crucial. What's next?
Were there any big one-time items skewing this number? Look for mentions of asset sales, write-offs, restructuring, weird tax things. Filter out the noise.
And finally,
How does this EPS compare to analyst expectations and the company's own guidance? That tells you about market sentiment and whether the company is meeting, beating, or missing its own targets.
excellent. That's a really practical checklist. So bringing it all home, EPS, earnings per share, it really is a core, incredibly compact measure of how much profit a company makes for each share of its stock. It's fundamental to valuation, especially the PE ratio, and it's a key signal of performance that the market watches like a hawk.
Absolutely. And here's the final thought we want to leave you with. As powerful as EPS is, it should never be used in isolation. Never. Always, always use it with context. Look beyond that single number. Consider revenue growth, look at profit margins, check the cash flow, track the changes in share count, understand the gap versus adjusted difference. True understanding, making smarter assessments, it comes from seeing the whole financial picture, not just relying on one admittedly important but ultimately incomplete number.